Welcome to TradeTheMBI.com. This is John. This report is for the 27th, and well, Fed did what everyone expected it to do, which was raise rates, which was a good enough reason to go ahead and sell into the pump. So we'd been seeing the declining shakeout. We'd had the steel falling, so everything had been pretty much in a neutralized condition to this point. We'd been testing the ABM yellow, and that's why I was pointing out those levels, because critical breaks of them become significant, particularly from a daily. Now, obviously, from intraday, we were already seeing peaking up at the top points as we were getting positive extremes every time we were breaking into two new levels. So it was already an indication that there was freedom to let go. And the reality is that we were even seeing what typically appears to be like that push move that fades. And of course, some people love these because, oh, it's a hammer at the highs. It's a definite. Well, that actually, if you're really going to follow, that has to be from a new high. But we're not going to get into that because the problem with chart patterns or candle signals and that is their failure rate is so significant that you can point to enough examples that work and enough that don't, that really don't help that much. Clearly, though, the NASDAQ doing exactly the same, right below the ABM yellow, and this one below the 76, right at it, actually. Put the numbers up for the close. Right there at 95.50, and if we look at the ABM yellow was at 76.23, so 30 plus points higher there, and the 76% line at just about 76. So also just fractionally below it. The euro not really fading much from the rise in rates, though you would think that treasuries from America would be attractive, especially with the potential for another rate hike, but people bought them in defense of a declining market. Not necessarily a smart play in my mind, but hey, gotta go where the defense is sometimes. Oil paring back just a fraction off of the peaks there, and that was the well, we hadn't had the snake. We had the actual orange above. The green was starting to turn. We didn't get it till literally last bar, right at the peak there at the close, right around the 1527. So it's an okay dip right to the ABM so far from that short snake movement. We'll see more of that on the intraday chart, very clean. And again, like we were talking about, gold just can't get even out of its own way. Despite inflation creeping up in that, it just hasn't been enough. So we started out with this ever-rising move that came from the dip of the orange. It continued to stay below green and didn't pop up until, guess what? Right at the first signal that we got for a short signal. That one's a little early because, like I was saying, you don't have the full green moving below red, and you also don't have red above, cyan above zero. Move over a couple bars, and you get exactly that, pretty close to the same price. This is always the interesting one because, yes, it did go down. This was at 29.26 and a quarter versus 27. So it's like 3 ticks. But these 3 ticks took very little heat. High on the next bar, 27 3/4, so like 1 point. And from there, took it all the way to the next buy configuration, which happened right here, below the 50%. So from above the 76 to just below the 50. And then it was a nice turnaround move. It followed clean until you would expect to see a change right as the orange is moving above, but with green moving over cyan. You have the midterm buyers, and it doesn't become as strong a factor. In fact, what you got was just a little bit more consolidation until another buy wave with also cyan under red, and that produced the first positive extremes, which produced this one. Not bad. The green below, the slight move of the orange, cyan was above zero and produced the immediate dip, but right after that you had the immediate inversion where steel shot right back up and closed it off. But at that peak, which just a couple points higher, you had to wait. You went from 29.31, and the actual short there was at 34. And what was the peak? 35 and a quarter. So even if you decided to hold on, you were barely 4 points to the downside. And this is where our 68 range always has been the ideal configuration. And then you can see from there, it was just a series of collapse and fade. We ended up with all these moves below the red line. Right here, we ended up with a little bit of a pop signal, but you could see that you're likely to retrace that low, at least come back to it. And as it started, it produced a very clean sell signal as it caved back right below. So it's one of those to me where it was just a matter of following the stops using the Fibonacci lines. There is what I typically do with them. And in this particular case, that produced an exquisite decline. And guess what it filled in, like we talked about before? The 29.15. Positive extreme from before, and so close to the 29.05 again to fill that one as well. And a lot of damage here with that below the negative 13. You can see it's finally improving quite a bit there. Actually, if we put up the deal content that I'm working, no, we don't have any additional pivots like we had back here. Pivot zones, and you had another one that happened right before the breakout here. What you're seeing with these FZs, FFs, so falling lows certainly are not going to want to generate a buy. It's going to look for ones that produce it secondarily, and certainly green crossing above red is great, but you still need to have the orange, and a lot of these other ones don't quite necessarily fill that category. So it's going to greatly reduce the number of false signals that take place, which is really powerful, I think, because it's going to make a huge difference in being able to even take dip considerations that end up like this, where you do end up with your orange, and then immediately can see when it breaks down, just so you know how easy it is to be able to get out just based on turnaround move, and increasing from while the ABM will be adjusted to moderate for that. So that's all going to be good. That'll be definitely coming with October indicators, so exciting stuff there. And as we fill the final details, you get gold here down to 23%. In modest buys, what you'd be looking for would be the rising orange, especially to take out this peak, would be the expectation then to really begin to fade this. You can already see almost positive extreme. That would not be ideal from a long standpoint, and this is typical of FOMC. You get the giant move and then it reverses usually an equal amount, which is almost exactly the case from the actual open. We were near that very similar number, and we filled it all back in. But definitely would be looking for that 29.05 range. So that's the long and the short of it for now. As always, though, I'll put up charts as relevant. Trade well.